So I'm going to restart recording now. So this will miss the first few minutes of the class. I'm sorry about that. So there's a lot of ways of looking at this. This is this bar chart is one way of looking at budgeted versus actual. This looks like a lot. If you remember from your statistics class, one of the things that was talked about as, and I know you're going to have to repeat that class, and I'm sorry that I didn't get your message, but I was out of town anyway, and so I'm not sure I could have been much help.
It's okay. I emailed a couple people and they were unavailable. It was my own fault for not planning time correctly, so I blame nobody for failing that class but myself.
Well, yeah, and I just feel bad because we're supposed to be there to help you, and I wasn't. So anyway, if when you retake that class, we'll talk.
Okay.
So if we look at this, this is a misleading graph. If we had started, and it's something that we look at, I mean, $30,000 isn't chump change by any stretch of the imagination, but this makes this variance look much greater than if we had started this at 0. Then these two would have been sort of much like this much different instead of this. So, but it is something that if you understand this scale, then it makes more sense, and it does tell us, gives us a good example here. Comparing expenses over time, again, we have a scale that, again, this one even looks worse, here. And of course, there is a difference. There's a $100,000 difference instead of 30,000. But all we're doing is this is just a visual that we can use, especially when we're making presentations to our senior management about the data. Let's take a look at long-term debt. Again, this is a comparison. In this, we got 3 hospitals, each with 100 beds, and long-term debt is this percentage is a percentage of revenue, probably. So 3 of these 100-bed hospitals, the 2 of them have fairly comparable long-term debt, but this one has none. And so my question here would be, okay, did this one just do their whatever created the long-term debt, which was probably either a mortgage or an expansion? Have they just paid it down, or is there something else going on here? Do we need to expand this hospital potentially, or expand the services, or do some capital investment? So that's a comparison.
So if you have like a hospital that's not doing good, you have these comparison graphs, and
right.
Hospital 1, 2, and 3, 1 and 2 are doing, it looks like, oh, that's debt. Never mind.
Yeah, we'll get to the other in a minute.
Okay.
Okay. If we look at expenses here, and again, we have what look to be very different numbers, 800,000, 3 million, and 900,000. But if we take a closer look, we've got 100 beds in one, 400 beds in another, and 100 beds. This is where we need to use consistent comparative data. And one of the ways that we do that in a hospital setting or in a long-term care setting is look at expenses per bed in the hospital. Then we have a better comparison. So if we look at this, we've got 100 beds in Hospital 1, and if we divide 800,000 by 100, it's $8,000 per bed. That's their expenses. Hospital 2, if we divide 400 into 3 million, we get 7,500 per bed. Hospital 3, it's 9,000 per bed. All of a sudden, these don't look so much different. What we might look at the 400-bed hospital is say, okay, there's $500 per bed less there. That could be an economy of scale issue. In other words, some of the expenses and contracts, you get discounts by having, you basically get a discount by being able to order much, much more, make larger expenditures for supplies, and so reduce the total expense. And in the other two, a difference of $1,000 per bed is going to make you want to look and see. That's, you know, a difference of going from 8,000 to 9,000 is an inflation, is a difference of 12.5%. So the question now becomes, what can be done to look at the two hospitals and see why one is more expensive? Maybe this one is in San Francisco and this one is in Reno. You know, very different markets and very different costs of operation. And that could be a contributing factor. You might also look and say to yourself, well, you know, these guys are getting a definite advantage. They're a much bigger hospital. Their cost per bed is lower. Can we do group purchasing for supplies and maybe get everyone to benefit from that? So there's lots of things that we can use this kind of data for. And again, this just shows the same thing. Again, this kind of a scale is misleading. It makes these look a lot different, a lot bigger than they are, but the visual is there. This larger hospital is cheaper per bed. We might go in and say why, there may be other factors as well. So we would want to not just assume that it's because it's a bigger hospital. We might want to look at how they're running. Another, looking at expenses here, this is looking at inpatient expenses in this hospital compared to industry standard. And again, this is probably percent of total revenue. So why are we above? And the question you'd ask as a manager is, why are we above industry standard? So these things might are of interest. Here's a sort of, this next slide really is something about annualizing your expenses, which basically means if we look at this table, we've got the table in the text. We've got 10 months expenses that are annualized to 12. Basically, we gross it up by 20% to calculate that. That's just a math issue. Inflation factors. This is inflation. The definition here, excuse me, for inflation is rather wordy, but basically, again, this is related to the time value of money because inflation is basically and the increase in costs of operation that are related to time and other economic factors. And if we know, when we're doing our calculations, we actually have to look at an inflation factor. So what we're looking at is here, this is a simple calculation. If we look at $1 today, then a year from now, if we have a 10% inflation factor, and we're talking about inflation here in terms of costs of goods, costs of people, costs of credit, costs of a lot of different things. So it's really accumulative. The example is simple, and we do have to make assumptions about this because of the concept of time value of money, which we covered in chapter 12 actually, and is pretty straightforward. That should have also been some of your accounting classes, but I'm not sure about that because I don't.
It was.
Okay, so that's not an issue. So at year one, that $1, what you could buy for that $1 now is going to cost you $1.10. So the year two, we're going to be 10% over that. So we're going to add 11 cents to this to take it to $1.21. So really, it's just 10% 1.1 times 1.1 times 1.1, and it inflates pretty fast. By year 4, we're almost 50% above where we started. So inflation, if at a 10% rate. So inflation is an insidious factor that we have to look at, not just year on year, but over time. So, and that's just what this is. 1.1 squared is, of course, 1.1 times 1.1, etc. So, and again, what we mean by nominal dollars is what we would have to spend to get, say, in 4 years, to get what would cost us today $500,000. We'd have to spend almost $750,000. That's at a 10% inflation factor. Fortunately, inflation in the general economy is lower than that, but in medicine, it's pretty heavy. It's not at double digits yet, but it certainly is approaching that. So that's something to remember. Medical operations are expensive. Why do we need to know that? Well, we need to know the effect on what we're spending, so we need to know the effect on what we can charge. And especially in a nursing home type of situation, or a long-term care situation, we already know they're pretty expensive. But then we get a lot of people that get maxed out in their money, and they have to use Medicare or Medicaid, which doesn't pay near as much as your private pay patients. So we're not going to go into converting foreign currency for the moment, although mostly in the United States, we're interested in what goes on in Canada and Mexico. It's not likely we'll be part of all of these others, but we do have to consider standardized measures. The standardized measures are really important when we're looking at EMR as well. And it's not just the wave of the future in healthcare, it's now. This book obviously was written before all the EMR stuff became mandatory. So using these inflation factors, we look at our projected revenue as well, and it depends on the hospital location in this particular case, or the facility location. And over time, we have to look at trends and what we expect to see in terms of our demographics. It's a complex issue that is no fun to deal with. So any questions out of this chapter?
No.
Okay, let's go to 15.
So now when they have those projected millions on there for those hospitals, now that's their projected revenue after expenses and everything is paid?
No, revenue is different. Revenue is basically what is the money actually coming in. So
That's right.
we'll get to this in a bit, but revenue is one equation that you remember from your accounting classes. We have sources and uses of funds. You remember that phrase?
Yeah.
Okay. Sources of funds can be revenues. That's one class of funds. It can be grants or donations or lots of other things. It can be, and in the medical field, it's usually the sources are our patients, either through private pay or through insurance or through the government. So this revenue is just just exactly that. It's just what is the money coming in the door. Has nothing to do. It obviously you want more money coming in than is going out, but we're more concerned there with the revenue, because that helps drive what we can afford to spend.
Right.
That makes sense?
Mm-hmm.
Okay. So let's take a look at the whole issue of operating budgets. Operating budgets are different than capital budgets. And so this is the budgets from operation. Basically, it is going to be a way to calculate profit or loss, or gain or loss of financial position within the organization. Capital budgets are a separate issue. They're handled differently, and they're usually long-term in nature, because we don't pay cash for our capital. We usually end up having to in some ways or another, finance such things. So they're treated very differently. The organization's objectives define what we're doing. I mean, and how we set them together and quantify these activities into financial terms. And by that, I mean, if you're running a long-term care facility, you've got you have a lot of choices. Do you have a memory care unit? Do you have a rehab unit? Or is it strictly is it a hospice, for that matter, which is, although we don't think of hospices as long-term care, they're run much the same way, but they have a whole different mission and objective. So we have to look at our the various activities and how they fit together to provide not only the care level that we want, but also to maximize their performance and to provide an operating profit. There's a process of budgeting. And we use that for and it's different in every organization how it's put together. So I'm not going to go too far into that. It's something that when you move into an organization, you need to understand what their policies and procedures are. But basically, a budget is it's a quantified statement of the plan of operation of the organization. Budgets are useful for cost control, and it also a budget. People within the organization actually need to understand the budget so that they can be aware of their part in controlling costs and delivering proper care. We have, I said there are two different types, operating and capital expense. Operating budgets deal with the short term. They usually cover a year. And that year can be your financial year, which may or may not be the calendar year. But it's mainly going to be your financial year with reviews on a periodic basis, depending on the size of the organization. That can be quarterly or even monthly. CAPEX budgets deal with the large issue of capital expense. The budget for each year will cover the current, remember that term out of accounting, the current costs and current debt service, but also they have to look into the future. There can be long-term periods for that. The cost centers and profit centers are basically, there is the cost centers, our managers really are looking at controlling the costs, and this can be the transportation department. It can be a number of different groups that might have a responsible manager. But overall, anything that's a profit center, which is basically something that's expected to return more to the organization than it spends, then the manager is responsible for the revenues and the associated costs. Transactions outside, I mentioned those before, grants, foundations, and the reason that we consider them outside the operating budget is that those grants and other kinds of transactions like that may require separate accounting outside the operating budget. So that's one of the reasons we look at that. Same with the foundation. So we'll just leave those out. So identifiable versus allocated costs. You have to, some things are easily identified, others have to be allocated. Mostly things like identifiable direct patient care and supporting patient care. These can be directly identified because we can pull them right out of the medical records. And we can say we spent X amount on patient care, and we have lots of historical data that we can deal with when we're doing our budgeting. G&A expenses can be allocated, and financial related expense such as interest on debt and that sort of thing are not at all in the operating budget for the managers. Variable costs and fixed costs, you remember those again from accounting. The variables will rise or fall, whereas fixed costs don't change. Variables might be, one of the examples here is the number of procedures, the number of patients. Fixed costs might be your staff, your full-time staff. Part-time or contract staff is a variable because you'll only use them when you need them, but you will have some regular staff that are there. They will be paid no matter what, and therefore that's a fixed cost. So we've got some things here. Gross salaries, payroll, taxes, and benefits, these are fixed. We know what they're going to be on a year-to-year basis. Part-time, temporary, contract, whatever, brought in, that's variable. We can control that. Expenses like drugs and medical, variable. It depends on the patients. But rent, insurance, leases, and so forth, those are our examples of fixed costs. Often, as I said, construction of a budget is usually dependent on the organization, but there are some steps that are universal. First off, we have to plan it. And by that, also, we have to plan to make the time available so that we're not doing this at the last minute and just really maybe being forced to not get good information, because we need time to get the information, which means looking at what's going on in the organization now, looking at what's been going on and where we want to go. Preparing the input merely means deciding what part of that information is going to be a part of it. And then we do a draft, and usually we will submit that to someone further up in the organization for comment, and then do any revisions that are needed. When I've had to do budgets, I've had to take this up and present it to whoever it was above me in the organization. When I was president of a company in Lakewood, it was to my board of directors. And when I was managing a department in the pharmaceutical world when I was part of that. That was presented to the vice president to whom my department reported. So we make that and then discuss that. Usually they will require some revisions. No manager is capable of looking at something and not marking it. So they will do that, and then we prepare the final budget. Here again, it depends on your organizations, the format, the scope, available resources, meaning this tells you, this idea of available resources in building a budget is looking at not just what you need to prepare the budget, but also meaning monetary resources and staffing, but what you might need to add to the organization in terms of staffing and so forth. And then levels of review and the time frame are all dependent on the organization. So the information sources are that we use to get our information are, basically the revenue forecast, which if you're a manager of a facility, you expect that revenue forecast to be coming from the various departmental managers. This can be done collaboratively, or you can say, I need your estimate of revenue, by X date. And that's when you then start looking at, remember I talked about looking at the question of reasonable. That's when you start looking at that and making sure that it's verifiable and reasonable. We need a staffing plan and other operating expenses. That can be virtually everything that is involved in running the organization, meaning the cost of supplies, drugs, laundry, all the other expenses that are associated with that. We look at checkpoints. Where do we need to add more people or more capacity? So we have a lot of assumptions. Assumptions are going to be assumptions about patient loads or client loads, assumptions about inflation, assumptions about the cost of staffing. So you need the information at a proper level of detail. And here's where judgment comes in. We can get so caught up in thinking we need more detail that we actually don't get the information we need, or we get too much. And so there is we need to think very carefully about what level of information, how much information we need, because we can inundate ourselves and make things much more difficult. Questions, special projects. This can be most anything. This can be someone decides to put together a task force to determine an expansion plan. That's going to take away some of the resources from doing other things in the organization. Has someone decided that they want to, let's just say we're at a long-term care facility and the management has decided that this year we're going to add a very beautiful garden to the facility. We need to budget for that. And we need to look at what resources are going to take away from other things in the budget. Inconvenient circumstances, renovation is a great example. If you've ever been in a place under renovation, it's can be very, very difficult to deal with this. When I was working in the pharmaceutical industry, we had to do some extensive maintenance work on our facility. And one of the things that was a problem was that the facility had been built at a time when asbestos was a common building material. Now, asbestos is if left alone, is harmless. Literally, it's not a danger. But the instant you start messing with it, then it becomes airborne. And that the renovation for that closed down labs, mean people have to move from one place to another. It was a very difficult process that, because of the way that's done, it took a couple of years. So those are kinds of things that can really mess with your with your budget, because inevitably they add expense, and they interfere with the ability of people to do their work. I was in a facility in Maryland last year that that was undergoing some renovations. They had a whole wing closed off. They had to move all their patients. It was really, it was really difficult on them. Okay.
Isn't that why so many buildings they're just being abandoned instead of renovated because of the asbestos, and it costs so much to renovate them rather than build something new?
That's a big part of it. Yeah. They're older buildings. The construction materials were like asbestos, difficult to deal with. Plus, we've got rules about what can go into landfills anymore. You know, just disposing of some of the stuff can be difficult. So yeah, and asbestos is a good example because it is such. Literally, you have to encapsulate the whole area in a bubble to keep the material from escaping. Your workers have to go in with respiratory protection and skin protection. It's a bear. It's a lot easier just to abandon. When I was back looking at places for my dad, I was staying with my nephew, and who lives in a small town in southern Maryland. And we were driving down the road, and there was a whole area that had been abandoned. They just chain linked it off and abandoned the buildings, and they were not, it was prime real estate. But I asked if there was a problem. He says it's too expensive to tear it down. So prime real estate, and yet it was not being used. And a lot of it had to do, given the age, and given the fact this was a town that had a naval base attached to it. It was undoubtedly built in the 50s or 40s, and so asbestos was a typical building material. So yeah. Okay. Your operating budget. Then you have to do the computations. Again, it has to be done with the assumptions in mind, and it needs to be consistent throughout, so that you're looking at things. Now we have static budgets, which is we don't look at the level of operations being adjusted during the budget period. So we have a static budget, and it depends on the department or the organization as to whether we have that, or flexible, which means that we can adjust to show change during a budget period. Examples of that could be there is some form of requirement, legal requirement, maybe through the regulators for changing certain aspects of the operations. We need to be able to be flexible in our budgeting to account for that, rather than try to fit it in sometimes, especially, and that can be an interesting argument with senior management as to whether it's reasonable to have a static or a flexible budget. So if you are further up the line, you're going to be reviewing the budgets. So you need to know how they're constructed, and you need to be able to annualize partial year expenses. Now that's if you're looking at budget reviews on quarterly basis, say, and you look at it and say, well, we've spent this much, so how much does that translate into, to the full year? We're midway through and we've spent 60% of our budget. What's going on? Because that implies that we're going to be 20% over budget by the end of the year at 120%. So we need to be able to look at that and think in those terms to ask questions about what's going on during the budget year. So budgets are always based on strategy and objectives, and they are based on assumptions. So we have to look at workload. We have to look at our budget operations. What is happening during the year that might change something like a special project. So here's a look at one thing. I'm not going to go through a lot of these. These are typical. You've probably seen things very, very similar in your accounting classes. Just looking at a static budget here. So this is a static budget, and we have a budget, say, of expenses. We're doing basically, we are looking at actual, we're looking back at the actual revenue and budgeted revenue. So what we're looking at is what's the variance here. And, if our actual versus budgeted is very different, it looks like we're about 10% under budget in terms of revenue. And we are 400,000 over on expenses. So the excess of expense over revenue here is significant. So we're looking at this from the standpoint of this is really going back and comparing budget versus actual so that we can look into the future. That's my take on this. So a lot of these things, again, we're looking at static budgets because flexible budgets are a little more complex to deal with. But here we have, again, a shortfall in revenue, an excess in expenses, such that the shortfall is a little bit calculated in the way that they're showing here. But we look at totals. We like to look at the changes in expenses over revenues. So here we have the excess of expenses. Actual versus budget was higher by $150,000 in this example. So there are a lot of things that we look at, and we look carefully at the numbers, and look at, we have to look at each of these classes. We got inpatient and outpatient revenue, so our total revenues were 1.5 million or so below our budget. Expenses were higher for inpatient, lower for outpatient, so the total expenses were this 101.7 million. So we have the difference here is that is that our revenue was down by 1.5 million. Our expenses were actually down by 1.7, so the total excess was only 150,000. So it's a little convoluted. Okay, does it make sense for this chapter?
Yeah, and now I see kind of, because it's like a use it or lose it. So you see, oh, okay, well, we were under budget by $1,900,000, so let's take that away from their budget, and now they got to deal with this, and so they just keep taking away and away their budget when they're underneath it.
Yeah, that's one way of looking at it instead of looking at why we were under budget.
Yeah.
And what can be done. Sometimes there's nothing you can do.
Yeah.
When you work for the state, so you know that they budget basically, okay, you were under budget, so that's what you get this year. And that doesn't help.
Yeah.
But that's different. When you're working with an organization that delivers healthcare, it's a little different. You can't just say, well, we're going to cut the budget because we didn't make that much last year. You're going to have to look at more a case of what is it that we can do to make this budget? What do we have to expend? Cutting services to your patients isn't really an option.
Right.
So it's a little different when you're working in a healthcare situation. Let's take a look at now chapter 16. A couple of these things we'll run through fairly quickly, I think. Capital expenditure budgets are critical. They involve a lot of thinking about long-term financial issues like financing capital expansion. So you're going to be taking on debt. So we need to factor that in. Plus, there's the usual other factors of looking at the return on investment. So what we're going to be doing, we're not going to deal with that. We've already talked about the difference between capital and operating budgets. So capital expenditure could be two things in two parts. Spending for assets already required. So that might be looking at, say, we have a new wing of our long-term care facility, and we need to do some renovations in there. That's a capital expense. But the assets are there. We just have to spend more money on them, or a new build out. So we need to look at looking at our cash flow analysis, and it needs to be cumulative. In other words, what are we expecting to spend over time? So in this particular case, we're looking at an example of buying some new equipment. Say we've decided to put up in our rehab department, we've decided that we want to have our own gym and PT equipment. So we might spend $50,000. No money is coming in because we've just bought it. But we might have old equipment that we're disposing of, so we can sell that. So the net cash flow is $44,000 instead of $50,000. So we look at this, a couple of things. We're looking at again some things that you've seen in your accounting classes. Looking at cash flow reporting, we can look at payback. How long will it take to actually pay back the cost of that equipment? The accounting rate of return, which is something that you've seen in your accounting classes. Net present value, or NPV, again goes back to that concept of value of money. And IRR. And the IRR, the internal rate of return, is basically, that's a percentage of, basically it says, okay, if we had invested this money, this is what we could have, what we would have gotten if we got this money, this amount of money over a period of, say, 10 years, that would be the equivalent of having invested it at some percentage of return. And we hope that that return is, of course, going to be higher than just putting the money into the market. But we need to construct this. When we're looking at a CapEx budget, we're looking at the operating budget as well, because the operating budget is what allows us to have the money to pay the debt or the capital expense. Okay, so I guess, again, we're going to look at this. We look at our operating revenue forecast and our staffing plan and our capacity level checkpoint plan. And we ask ourselves several things. Do we need additional equipment? If the answer is no, well, that's the end of the discussion. If it's yes, then we need to go into the money that we estimate that it will cost. These are all estimates, unless we have firm, committed proposals from suppliers. Then it goes into our CapEx plan, which then goes into the budget. Additional space or renovations? No, well, then it's over. Yes, however, that has to go in, and that goes into the CapEx plan. And that's a two-way street, because our CapEx plan tells us what we can afford in terms of capital expenditure. And then, of course, everything does go into that budget. So we have to have all this information in order to construct it. Startup costs means basically, you don't just put the building and open it up. There is a cost required for getting that done, and it might include additional temporary staff. It might include the cost of overtime workers, say moving equipment back and forth into various departments. So the process is going to depend on your organization. So this could be, we've talked about that, acquiring or upgrading equipment, replacements, new programs. You may decide, your facility may decide that it needs to add a long-term care, or a memory care unit if it doesn't have one. These are expensive. An expansion of existing programs, or thinking into the future, thinking, well, we believe from our demographics and everything else that we are going to need to expand our facility in the future. So we may want to acquire assets today that are going to be useful in the future. This is a much more abstract exercise. Rationing. We only have so much money, and it's all based on what we think our operating revenue is going to be. Operating revenue is basically the difference between the actual revenue and the expenses that we incur. So we have to, when we're rationing, we look at several things, which include our mission and our overall vision for the organization, but also the necessity and the cost of capital. Capital is not free. So we look at the cost of that. Again, that's basically our interest rates. We're going to have to borrow the money. It's going to be at some rate. Is the return that we can get from the capital expansion or capital expense greater than the first off, the cost of capital, which hopefully it is, or in alternative investments. And basically, most of our medical organizations don't put their money into things like capital markets or anything like that. So, but we may be looking at several different ways to go in terms of our capital expansion, and we need to look at the relative return of each of them in order to make good decisions. So evaluations can either be objective or subjective. Subjective, of course, is essentially putting a finger into the wind and saying, okay, yeah, there's a breeze blowing. Objective is, here are the details, and this is our best estimate of, based on these objective measurable criteria. We might look at history. We might look at what other organizations may have done. So we score all the proposals and then rank them. So what's the payback method? You've probably seen this. What do we expect for the cash flow that comes from our expense? So here is a simple one: $20,000 a year for 5 years on a $70,000 investment. Basically, this is cumulative. At year zero, that balance is $70,000 each year. We subtract $20,000, so we get down to the point where in the last, when years 4 and 5, we're actually returning money that's in excess of what we actually spent. Accounting income, as we look at depreciation, again, the cash flow depreciation of the asset is $12,000. If we look at a 5-year declining balance calculation, and then the balance net of depreciation then is $8,000. So we use those figures, and we look at the cost of capital now. Let's look at this net present value type calculation. We've looked at the present value of these various cash flows. So we've got cash flow of $20,000. If we look at a 10% cost of capital, then we've got these kinds of calculations that we make. So we end up calculating all of this and calculate a net present value here of this much. So of the basically, we're saying that this 70,000 expense has returned a net present value of positive of almost $12,000 over the lifetime of this expense. So there's these various different ways of analyzing it, but it's always, management's going to want to see some analysis of the value. Okay, so let's move on quickly to 17. As I recall, this one is a bit more of an abstract picture. Variance analysis and sensitivity analysis. So variance analysis really is what's the difference between actual and either standard or budgeted amounts. And we can look at volume, meaning, how many of some quantity has been used, or how much material has been used, and what's the variance here, spending, or the units that we've done. So volume here, we're looking at workload. So we're looking between the total budgeted cost and the actual expected workload, and the amount that would have been budgeted had the workload been known in advance. This is sort of again, variance analysis is retrospective. So we look at the standard hours that we use. That can be industry standards or it can be internal standards. portion of the overall variance caused by a difference between units that we've put in versus the units of output. This is a complicated, I mean, a kind of a generalized statement. Basically, we look at the how many hours of or how many hours of nursing time, say, is put per patient, as opposed to the budgeted and actual level there. It's an unusual kind of calculation. In terms of spending, we know this. We can look at that. We can look at the difference between actual and budgeted unit price. This could be the unit price of say meals, or it could be the hourly rate of our labor, or supplies. And so we look at that per unit of output, meaning basically how much money has come in as a result of that, and how much actually came in. Variance analysis is again a budgetary approach, or a variance that uses multifactorial analysis. We may compare the variance to the budgeted costs. We may we may compare everything to volume, use, and spending. We might compare all of them and use that as a means of looking at what happened in the budget. The purpose of variance analysis is what happened and what can we do about it. So it's very useful and very appropriate to use a flexible budget approach, because the purpose of doing variances is saying, okay, how do we adjust things at this point? So our flexible budget looks towards a range of activity, and as opposed to the static, which only looks at one. So we're not going to go into a lot of these, and we can look at some of the practice. What we do is we're comparing here a two variance analysis. Price variance, we got a favorable $100,000. It cost us less than we planned. The quantity, however, may be 20,000 over. So the net variance is an unfavorable 20,000. So we look at our net variance. We want to look at these numbers very carefully. Here's an example. The actual cost here in this example, 950,000. Our budget, our flex budget was 100,000 more, so we have that. The budgeted cost, however, was 930, where with our flexible budget we were under by 120,000. So the net variance is from budget to actual was 20,000. Now, if we take a look, we could actually just look at actual versus budget and see that our variance was 20,000. But the purpose of these various analyses is to find out where the differences occurred. So a good example here is in this particular case, looking at the actual versus budget on the therapy portion of our therapy departments in an organization. if we were looking at a cost, an actual cost of $950,000, and the therapy minutes, this is the activity level. That means that the cost per therapy unit actual was $2.71 a minute. Our budgeted was 930,000, and the budgeted cost was 310,000. So our cost per therapy minute was to be $3 a minute. So what we're looking at is the actual cost us less per unit. So what we're seeing is the reason we had such a difference was mainly because of lower usage of therapy. So this helps us understand why we had a variance in our budget. Does that make sense?
Yeah.
Okay. I'm not going to go through all of these because we're getting to the point where we're about to run out of time. So it can be applied, variance analysis can be applied to both types of budgets, flex and fixed. Basically, we can look flexible budgets being based on levels of operation that'll change. Fixed based on a level that's never adjusted during the budget period. So we look at this to take a look at another side. We know that variation is going to occur. Budgets are estimates. They're almost never perfect, and especially in an organization that has so many variables in the way it gets its revenue. So we look at sensitivity analysis as part of our budget to say, well, what happens if, what happens if we have a sudden change in demographics? What happens if we experience a major disaster and we need, as a hospital, you're always looking at what happens if there's a, something that that suddenly pushes a lot of people into that setting. So our sensitivity analysis is looking at the things that can actually bust our budget or can improve our budget. So the places where there is most likely to be an effect. One place, obviously, is when we're looking at a budget, say in a long-term care facility, is what happens if we have a sudden outbreak of norovirus in our facility. That's going to affect the need for direct care, and it's going to affect the need for treatment. You also need to factor what happens if, as a result of that, we lose half our staff to it because it's such a horrible infection. So we do need to think about these sensitivity analyses, and that's why budgets usually have the most likely case, a best case, and a worst case scenario. We always hope that there will not be a worst case event, but there could be a lot of different things. So what we do is look at break-even points, and when we're looking at the various tools, we want to know what is our break-even. In other words, what is the point at which expenses and revenues are the same, and then we look at our target operating income over the time period. The contribution margin is the difference between revenue and variable costs. The difference then is available not only for covering our fixed costs, and remember fixed costs are facilities and things that we have that don't vary with usage, and operating income. So we hope that our operating income is always a positive. Here's an example here, revenue, variable costs, contribution margin, and then we take the fixed costs out. These are examples, obviously. So we have the target operating income is based on our assumptions of that break-even point. And if we look at the break-even point, the break-even point is that which operating revenues and costs equal each other. In other words, operating income is zero. We've covered all of our expenses, but we don't have any excess cash. So there's an exercise here in the chapter that uses some thoughts as well to look at those. So questions about this particular chapter?
No. Let's
go on and finally get to number 18. We'll try and get through this quickly here. Estimates, benchmarking, and measurement tools. Estimates are something that you're going to do. Estimates can be of sales amounts. It can be of the estimate of the value of our equipment, or size, meaning the amount of material used. There are all sorts of things. Some things can it be estimated? We can estimate our costs of labor. We can estimate our costs of capital by appropriate data. But the estimates are not firm numbers. Estimates are done so that we can get an idea as to where the organization is going, and therefore they are not accurate, or they're not accurate to a real fine degree. Most people understand that. Estimates are, I had a joke when I used to do forecasting in the pharmaceutical industry, is that the joke was that forecasting is difficult, especially if you're talking about the future, because we don't know what the future is going to bring. However, we need to look at estimates are generally done because somebody needs an answer quickly. Is this a good idea? This is my best estimate. Yeah. We don't have enough data. We are looking at the benefit and cost of various things. Pharmacy is one of those. An example here, an internal monthly statement for ending estimates is an estimate. We know the recorded inventory. We know the purchases during the period. So we can calculate the cost of goods available for sale. We know that. Okay. The recorded inventory has a price on it. Purchases has a price on it. So we know this. Estimated cost of goods sold. Here we are looking at, in a period where we're estimating how much we're going to sell. So then we can, from that, have an estimated inventory at the end of the period. So really, what this is a purpose is somebody saying, what do we think our inventory, our drug inventory is going to be at say the end of September. So we're making an estimate. We don't know what's going to happen. They're general, there are other things that can make them less accurate. Looking at, here's an example of adding a physician to a practice. We're estimating that we have to add a half-time RN. We're estimating that we're going to have a 10% overall increase in indirects. The negative impact of unrecognized indirects are a list of things that might be required. We can look at, in our estimates, weighted average inventory costs, or we can look at, we can use our estimates based on what we know for standardized costs through our industry. So we have various performance measures, which we've looked at here. The performance, basically, we look at looking at our performance measures over time by using comparative analysis of one period to another. The performance over various time periods are useful in terms of looking at the financial health and where we're going with the organization. Benchmarking is looking at the products and activities, services, revenues, expenses, and so forth against our best levels of performance, either within or outside our organization. We can look at financial benchmarking and non-financial variables. Usually benchmarks are used to measure performance gaps. We may have as our benchmark having a certain level of revenue from our rehab unit based on the cost of operating that unit and an assumed level of patients in that unit. Our benchmarks then are looked at as being compared to what our actual performance might be. In this particular case, if we have, as a benchmark, we view as having the rehab unit 80% full. On average, we can look at any one of our time periods and say, okay, this period we were at 90%, and this last period we were at say 75. So we're looking at how we can either determine that our benchmarks are legitimate, are reasonable, or we can look at how we can we may want to if we're consistently not approaching our benchmarks, we may want to make decisions about the rehab unit and how many patients we want there in the first place. So we're looking at these benchmarkings to really examine how they compare with our competitors against non-competitors. If you're looking at benchmarking, say a hospital and benchmarking with Mayo, a world-class clinic, you may be looking at that. It may or may not be reasonable to do that. And then you want to look at the processes within your organization for benchmarking that you want to replicate. We look at financial benchmarking, basically is looking at how we compare with our common peer group that in the business, and that's real common. We especially with long-term care, we're going to be looking at those things. The Pareto principle is the 80-20 rule. We all know that 80% of the problems are caused by 20% of the causes. So we can look at that and look at as an analytical tool to look at what what problems we have. Now, if this assumes we have problems, and we may or may not, but looking at a Pareto analysis, Pareto is, this is a Pareto plot. Basically, it's just no gap between the bars here. And so we're looking at, in this particular case, say we've got a billing department and we're looking at the various activity. And in this case, I'm not going to, I'll look at this. You can look at all of these things yourself. We're looking at processing denied bills. That's 51% of the activity in our billing department. So how can we reduce the number of denied bills? Okay, so we're looking at review with supervisor. This is current. This is a snapshot, obviously, here of what's going on at any one time. So 10 of them are at review. How can we reduce that so that we can get the payment? And then some smaller ones we are things that we may or may not be able to influence, such as locating and documenting the problems. So what we're looking here is that 74% of the problems are in these two activities. So we want to look at how we can cut those down. So quartile presentations of data are part of statistics. We'll get into that when you retake statistics. Okay, so that's those chapters. Any questions out of that one?
No, sir.
All right, so let's go back to here and take a quick look at this week's discussion is about time value of money. I think I know you've discussed that in your accounting. You shouldn't have a lot of issues there. This week's assignment is a little more complicated. You're looking at 4 uses of comparative data in healthcare and provide an example of when each may be useful. What is the manager's main responsibility? So you're going to have to really look at the comparative data chapter, which and review and the various ways of comparing data. So look at that chapter in some detail. You need at least an outside source other than the text as well. So it's suggested that you make use of the SHARC materials that we have. And then you have the assessment. This assessment is a longer one, so take your time. I know you're not working the next couple of days, but you may be doing some care for your mother-in-law. Let me know if there are any problems.
Okay.
Getting things done. We'll work it out. Okay?
Okay.
Okay, so make sure you do your daily checkpoints. I know that you're working and missing a bunch of them. Don't lose those points. And we'll get this work done next week. I'll record something again on Tuesday and upload it. It may be a little shorter. We have fewer chapters, I think, next week to deal with. Let's take a quick look. Yeah, there's only 5 chapters as opposed to 9. But I've looked at them and they have they're interesting chapters. So we'll spend some time on that.
Okay.
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 Anything else, Crystal?
No, sir, that's all.
Okay. Then I will see you next week.
All right. Have a good weekend.
You too. You too.
Bye.
Bye now.